Are institutional investors turning their backs on Bitcoin? Just this past week, institutions kicked off the new year by pouring over $1 billion into Bitcoin ETFs in only 2 trading days. One of those days saw a massive $697 million flood into the funds, the biggest single day gain in 3 months. But that's probably not the story you heard a few weeks ago, is it? Not long ago, the crypto world was in a full-blown panic. Headlines were screaming about an $867 million institutional dump from Bitcoin ETFs, and red candles were everywhere. Everyone was asking the same terrified question. Are the big money players, the so-called smart money, finally cashing out and leaving retail to hold the bag? Well, what if I told you that entire panic was completely misguided? In this video, I'm going to show you why those scary headlines were dead wrong and how the real story, the one happening right now, is pointing to a bullish move that's bigger than ever. Stick around because you're not getting the full picture from the mainstream news. And if you think that outflow meant institutions were leaving Bitcoin, you're about to misunderstand the biggest accumulation phase of this cycle. So let's talk about the elephant in the room. The story that had every retail investor sweating just a few weeks back. On November 13th, 2025, the market got rocked by news of a colossal $867 million net outflow from US spot Bitcoin ETFs. This wasn't just a red day, it was a signal that sent shivers down the spine of the market. This event was framed as an institutional exit, but that framing is exactly why so many retail investors sold at the worst possible moment. This pressure didn't happen in a vacuum. It helped drag Bitcoin's price down significantly, dropping a painful 25% from its highs in October. For a lot of people, this felt like their worst fears were coming true. The institutions that legitimized the bull run were heading for the exits. The headlines were brutal. You saw them. Bitcoin ETF outflow crisis and historic November outflows, painting a picture of a market on the verge of collapse. Social media, of course, turned the panic up to 11. You saw the charts, the dramatic red lines, and the posts asking if this was the end of the cycle. And to pour salt on the wound, the outflows were broad. Grayscale's funds saw hundreds of millions walk out the door. Even BlackRock's IBIT, the king of the ETFs, got hit with a staggering $257 million in redemptions on that one day. When you looked at the numbers on the surface, the conclusion seemed obvious, right? The institutional party was over. They came, they pumped the price, and now they were leaving. It's a simple, scary story, but it's also the wrong one. And this exact misunderstanding is how retail keeps transferring coins to institutions every cycle. So what was really going on? To understand why that sell-off wasn't the doomsday signal everyone claimed, we need to pop the hood and look at how these financial products actually work. This isn't a story about institutions abandoning Bitcoin. It's a story of rotation, rebalancing, and sophisticated financial moves that are actually paving the way for the next bigger wave of adoption. The mainstream narrative focused on a single scary number in a vacuum. But when you zoom out and connect the dots, a completely different picture emerges. This wasn't capitulation, this was a tactical repositioning. And while retail was focused on ETF flows, the real accumulation was happening somewhere nobody was looking. All right, let's break down the real data and bust this myth of an institutional exodus piece by piece. First, let's put those outflows into perspective. In late 2025, the total assets under management, or AUM, for all spot Bitcoin ETFs was over $120 billion. So even during that period of fear, the total drawdowns represented a tiny fraction of the whole pot. That's not a collapse, that's a rounding error. Even after those outflows, the total AUM for Bitcoin ETFs has since climbed to over $124 billion. This isn't a leaky bucket, it's a massive reservoir. Here's what almost nobody checked. Second, let's talk about why the money was moving. The narrative assumed every dollar leaving a Bitcoin ETF was an institution selling Bitcoin. That's a huge oversimplification. A big part of this story is about rotation. Before the new spot ETFs launched in 2024, the main game in town was Grayscale's Bitcoin Trust, GBTC, which came with a notoriously high management fee of 1.5%. When new ETFs from BlackRock and Fidelity hit the market, With fees as low as 0.25%, a financial migration was guaranteed. A lot of what looked like selling was just investors making a smart financial move, holding the exact same asset, Bitcoin, but in a cheaper fund. That wasn't selling, it was cost optimization. This is where the data gets uncomfortable. Third, what about the bigger picture? These outflows didn't happen in a bubble. In late 2025, there was a lot of uncertainty in the global markets, causing a risk-off move everywhere, not just in crypto. When big money managers get nervous about the economy, they trim their more volatile assets, like tech stocks and, yes, Bitcoin. This was a textbook response to a shifting macro environment, not a vote of no confidence in Bitcoin specifically. And this next part flips the entire story. Fourth, and this is the point that the mainstream narrative completely missed. While some money was flowing out of Bitcoin ETFs, where was it going? It wasn't just vanishing. In fact, on some of the very same days that Bitcoin ETFs saw outflows, there were significant inflows into other crypto products. Since launching in November 2025, the new spot XRP ETFs have attracted a whopping $1.2 billion. At the same time, Ethereum and Solana ETFs were also seeing investor demand. This isn't an exodus from crypto, it's a rotation within crypto. And if you were watching only Bitcoin headlines, you missed where that money actually went. If you want to spot institutional rotations before price reacts and headlines reverse, subscribe. And while retail was watching ETF headlines, the biggest buyers in the market were doing something completely different. And while everyone else was panicking about outflows, the biggest players in the market were doing the exact opposite. Now that we've put the fear-mongering to bed, let's talk about the real story. The much bigger move happening right under the surface. Far from turning their backs, the smartest players are digging in deeper. Let's start with the whales. While the ETF flow data caused a temporary panic, what was the largest corporate holder of Bitcoin doing? Look at Strategy Inc., formerly MicroStrategy. On January 12, 2026, the company announced it had just bought another 13,627 Bitcoin for about $1.25 billion. This purchase brought their total holdings to a jaw-dropping 687,410 BTC. Does that sound like a company that's losing faith? They aren't just holding, they are actively using any price dip as a massive buying opportunity. Strategy Inc. isn't an anomaly, it's a blueprint. This is how institutional conviction actually looks when price dips. While retail was debating headlines, institutions were wiring billions. And they're not alone. Now look at the institutions that actually issue these ETFs. BlackRock, the world's largest asset manager, saw its IBIT fund take a hit back in November. But let's zoom out. To start 2026, IBIT has already seen a staggering net inflow of over $888 million in just the first few trading days. And who's one of the biggest holders of BlackRock's Bitcoin ETF? None other than Goldman Sachs. Filings from early 2025 showed that Goldman Sachs had dramatically increased its stake in IBIT, boosting its holdings to over $1.4 billion at the time, making them the fund's largest known holder. Think about that. A pillar of traditional finance isn't just selling Bitcoin products to its clients, it's aggressively accumulating a massive position for itself. At the same time, Morgan Stanley is filing with the SEC to launch its own spot Bitcoin and Solana ETFs. These are not the actions of institutions that are scared. These are the moves of giants positioning themselves for the future. Finally, let's talk about the sheer speed of this adoption. In their first 2 years, the spot Bitcoin ETFs have attracted tens of billions in net inflows. How does that compare to the launch of the first gold ETFs back in the early 2000s? Let's just say the adoption of Bitcoin ETFs is happening at a pace that makes the launch of gold ETFs, one of the most successful financial products in history, look like it was moving in slow motion. The digital gold narrative is no longer a theory, it's happening right before our eyes. Institutions don't announce exits, they rebalance quietly. By the time headlines confirm it, the move is already over. And this institutional accumulation phase usually ends the same way, not with a headline, but with a price that suddenly makes those headlines look ridiculous. So let's circle back to where we started. Are institutional investors turning their backs on Bitcoin? The answer is an emphatic no. What the headlines framed as a panic-driven dump was actually a logical and even healthy series of market events. It was a small correction after a massive run-up. It was a smart rotation out of high-fee products into cheaper ones. And most importantly, it was a strategic reallocation of capital by increasingly sophisticated players who are now active across the entire digital asset ecosystem. While the surface-level data showed a temporary outflow that spooked the market, the deeper currents reveal a much more powerful story. We see corporate titans like Strategy Inc. buying Bitcoin by the billion. We see financial giants like Goldman Sachs becoming the biggest holders of Bitcoin ETFs. And we're witnessing an adoption rate that is completely dwarfing historical comparisons. Far from turning their backs, the institutional players are just getting started. That so-called dump was nothing more than short-term noise in a long-term financial revolution. The smart money isn't leaving, they're just moving the chess pieces, getting ready for the next big move. The real story isn't the sell-off. It's the massive accumulation happening right under everyone's noses. The question isn't whether institutions believe in Bitcoin. The question is whether retail learns to read what institutions actually do. What do you think is the next big institutional move in crypto? Drop your thoughts in the comments below. Thanks for watching, and I'll see you in the next one.